Dylan, thank you very much for joining us today. How are things in the great city of Toronto?
Very well, thanks, Jimmy. Always a pleasure to be out. Thanks for having me.
And when I say the great city of Toronto, I'm being sarcastic because, as we both know, Toronto has many issues, and many of the issues have to do with the policymakers and the decisions that they have made in the last few years at all levels of government. But before we discuss Toronto and the issues that it is facing as a city, why don't we first start with the country as a whole? What's your take on the Canadian economy right now?
Yeah, so I think you've talked a bit about Toronto and having hard times, and I think you're talking beyond the floods we had a couple of weeks ago into some of the more economic issues. I think that reflects a lot of what's happening as well in the macroeconomy in Canada generally. So we are fairly bearish and fairly pessimistic on the immediate outlook. We think some serious policy action is needed, both from the Bank of Canada, but also from the government more broadly to start fixing some of the issues that Canada's facing. And I would split those into kind of structural challenges and cyclical challenges. And maybe we can talk a little bit around both of those. So on the structural side, it's kind of no longer a secret that Canada's in a pretty tough place in terms of the ability of its economy to be competitive on the global stage and to generate sustainable growth for citizens of Canada. So we've seen, for instance, productivity has basically stalled over the last 10 years. I think cumulative productivity growth over the last decade has been about 1%. And that's not just because of COVID. It's not like there was a big dip around COVID that we're still recovering from. It's been flat the whole way through. At the same time, we have real income growth as a consequence per capita is negative, right? So as the population grows, the individual Canadian on average is becoming less well off. So even though we're seeing a very important bump to overall output that we're getting from the immigration surge, it's not translating yet into generally better welfare. It may well in the future, but we're still in the phase of the process where we're getting headline growth, but underlying weakness in incomes because we haven't seen the productivity benefits just yet, and we're actually seeing immigration papering over a lot of more fundamental problems in Canada. I think it's worth pointing out Canada's not the only country that's seeing some of these issues. The most direct analog, actually, we always look to the US, but it's the UK that looks most similar. An equal kind of productivity collapse over the last 10 years there. Less of a mystery as to why it happened because they cut ties with their largest trading partner and largest investment partner. And so it's much easier to explain in the UK, obviously, a results or significantly contributed to by Brexit. But a lot of the themes in the UK will be similar to Canada: undersupply of housing, very high housing prices, recent high inflation, very high interest rates. The big difference is that the UK now has a government that has made these issues absolutely front and center of the economic program. It is all about investment, productivity growth to generate genuine economic growth. That's something we're lacking a little bit in Canada, and so still sort of searching around for those solutions. So that's on the structural side. General erosion of competitiveness, generally low investment or sub required, and as a result, some of weak real income growth. Cyclically, there are a few issues on the outlook as well that we're quite concerned about. So as we know, there was this big period of inflation over the last between 2021 and 2023. People don't realize this, but it's done. Okay, we're still adjusting to higher price levels. I still get surprised in the grocery store by how much certain food items cost, but they have stopped growing at a rate that is concerning to the outlook. So if you look at core measures of inflation, and that still, by the way, includes high mortgage rates. Canada is one of the only places that includes mortgage rates in these measures. Core inflation is sitting between 2.3 and 2.7% on the latest reading. The target is obviously 2% or between 1 and 3% overall, so comfortably within the band and still trending down. There's really nothing to worry about on the inflation front, and that means that the Bank of Canada has started cutting rates. Currently sitting at 4.75%, probably going to come down in a week's time and continue to come down. But compared to what we consider a neutral interest rate, one that would sort of be consistent with keeping the labor market where we wanted, keeping prices around 2%, very restrictive still. So a long way still to come down. And that's a problem because, as we know, high interest rates, restrictive policy, the effects show up with a long lag. So 1, 2, 3 years before you see the full impact of that hit the economy and then wash its way through. So we're only seeing this, coming on the horizon now and in the next year or two. And one of the biggest channels for that, of course, is through the housing market and the mortgage market, because half of the market still needs to reset to higher rates. Everyone locked in 5 years of record low mortgage rates just around the pandemic, and they will renew between now and the end of 2026. That is going to cause an enormous hit to household savings, which means that people have to just save, i.e. withdraw funds from the stock market and elsewhere. That means that the average mortgage payment by a Canadian, if rates stayed where they are now, will double. And it also means that as a consequence of those two things, you're going to see supply being released into the market and house prices going down. So if the Bank of Canada doesn't aggressively reduce rates, there is a real problem coming from the housing market via the Canadian consumer. But nothing happens without costs. Even if the Bank of Canada does reduce rates very rapidly, as they should, we will see it coming through and hitting the economy in terms of weak looting, right? So that on the margin, a little bit inflationary, but more importantly, it really helps some sectors, it really hurts some other sectors, depending on the export or import orientation of those sectors. So a lot of change on the horizon and a lot of potential to move too slowly from policymakers, both in the central bank and in government. That's kind of where we see the broad picture. There's a lot of detail we could get into there. So happy to go whichever direction you want.
So I do want to have a deeper discussion on the real estate market and what it means to the consumer. But I want to first ask you something about productivity. You said productivity has been in decline for 10 years. And I'm kind of shocked to hear that, because if you said it's been going on for 1 or 2 years, okay, the U.S. economy is slowing down, the Canadian economy is slowing down, but why 10 years? I don't understand what's happening here at the federal level that it's been declining for so long.
Yeah, I mean, worth pointing out, it's been stagnant. So we've stopped seeing productivity growing. Now, there's lots of different ways you can grow an economy, right? But the most enduring and most long-term way that comes with very little inflation and also very sustainable fiscal outlook is to get your workers to produce more by the time that they have. And that's productivity growth. We call that total factor productivity in economics. What are all the reasons how it worked in the economy? And it's one of the most difficult concepts to measure in economics, because it's sort of like the left behind after you explain everything else. After you explain, okay, we've had a massive capital investment and there's 200,000 new factories, we can account for that growth. Or if you have a massive surge in immigration, as you have simply a larger labor market, everyone needs to do something with their time, and so you get more activity as a result. But then the kind of leftover is, okay, what's explaining all the rest of the growth? That's total factor productivity. And that that depends on like the deep foundations of what keeps the economy growing over a long period of time. It's innovation, it's diffusion of innovations into the economy to improve how you produce value within the economy. And it really requires long periods of strong investment, both in terms of capital goods, but also in terms of investing into your people. And so when you look at these productivity pauses, they often are associated with periods in which you're seeing subpar levels of overall investment in the economy, or the distribution of that investment is into sectors that can only provide limited productivity growth, right? And I think there's a combination of those two things happen in Canada. When you invest tons and tons and tons into the primary sector, you kind of get a 1-for-1 in terms of where the output is. But if you are sort of San Francisco and you're investing into real innovation and real output improving technologies, similar in the sort of farming industry, then it's those places that you get very deep potential for long-run productivity growth. And I think that's what Canada's missing a little bit. It's the amount of investment, but also where it's going and how productive those sectors are.
So is there a direct correlation between productivity and real incomes?
There is. There is. Via two channels. The first channel being that, if workers are producing more value per hour, that extra value gets shared between business owners and workers. Right. So exactly how much they will get in terms of income growth for individuals, depends on that sort of balance of power between, capital and labor. But, income growth is returns on both of those things. And so you get far higher income growth for an economy where productivity growth is higher. And you said real income growth, which is important. Productivity-based growth doesn't put pressure on the supply side of the economy. It allows you to do more with the capital that you have and with the people that you have. And so it is not inflationary. If you juice the economy with, say, huge amounts of government spending, you're pushing more out of the same level of capital, the same level of people, but actually, that's productivity growth. If you're just saying, let's try and hire more people because we need to produce more, you start running into labor market constraints, you start pushing wages up, you start getting inflation, or your utilization rates on capital start getting very high and you get inefficiencies and supply chain problems, and that's inflationary, right? So productivity-based growth can come with low inflation, and that's also great for real income.
Okay, so let's talk about what all this means for the consumer. And when you look at the consumer in the U.S., 70% of their GDP is from consumption. What would that number be in Canada? How important is the Canadian consumer to economic growth?
Yeah, so for all modern advanced economies, the consumer is the majority of growth. It's a little lower in Canada than the US just because of the distribution of you have more primary industry, and real incomes are a little lower in Canada. But it's not far off. Like fundamentally, the point is that you declare a recession when consumer spending eventually drops. You usually get investment slowing down first, but that's a smaller portion of the economy. And when that tracks through to the consumer, that's when you see a genuine recession happening. Similar on the other side, you're getting growth. So the consumer is central. And what we've been seeing in recent kind of quarters is what we would call sort of sub-trend growth. So it's been ticking along at kind of averaging 1% growth per year. That is sure not a recession. Something to write home about at all. And it's certainly not enough to offset the population growth that Canada's seeing in terms of real income generation. So this is all filtering through. Basically, the general pattern is you've had a high inflation episode, you've had some level of catch-up wage growth, but it hasn't been enough to boost real incomes in Canada. And so you are seeing a consumer that has now completely spent down all of the savings that they had coming out of the pandemic, barring the savings that they need, as we'll discuss, to offset the mortgage adjustments that are coming. So an unwillingness to do that much more. And unlike the US, you aren't seeing these massive amounts of just saving. So the consumer's in a pretty weak position right now. That comes through in all the latest retail sales numbers, which are even lower than the GDP numbers. So there's an underlying weakness to the Canadian economy, which we don't think is getting enough recognition in places like the Bank of Canada, who are sort of very narrowly focused on inflation numbers.
So you touched on immigration, and it's well documented that the Canadian government has adopted a very aggressive immigration policy. In 2023 alone, they brought in over 1 million people, half of which came into the Greater Toronto area. But how has this aggressive immigration policy impacted GDP and productivity and lower incomes?
Lots and lots of ways. It's impossible to have such a large change in such a small amount of time without it affecting all sorts of parts of the economy. And I think, again, this topic gets quite sensitive for people, and it's, people don't like criticizing the policy overall, and it starts generating all sorts of other discussions. But I think we can, as economists, look at this very rationally, at a very balanced way, which is what we try to do here. So let's start off with the sort of underlying logic of immigration and Canada. It is a fact that at the current birth and death rates, Canada's population would shrink without immigration, right? That creates big problems for funding old age care, for funding pension funds, for keeping, the economy kind of growing and ticking along. So as with most developed economies, there is a certain need to boost population growth and to keep the population from aging excessively. And the easiest way to do that, because it's quite hard to incentivize people to have children or force them to do it, is to allow immigration. Canada traditionally has been very strong at this. Its kind of geographical location has enabled it to enact a very effective immigration scheme which targets skilled individuals who are looking for a better life in Canada, and you can tailor that to basically the skill shortages you're seeing in the wider economy, and that's served Canada very, very well until you get to the pandemic, where things have changed quite substantially in a few different ways. So there was a period, obviously, during lockdown and during international travel restrictions where immigration actually dried up for. And what the government said at the time was, well, we're going to make up for this by allowing faster immigration for a period, which, is okay. But that faster immigration was unprecedentedly fast. And it wasn't 1 year of offset. It was basically 5 years of offset because the current plan expires in 26. And so Canada's population growth year on year, Canada has been welcoming more than 1% of its population into the country every year. And in demographics terms, that's an enormous shift. And I think when that was underappreciated in terms of all the knock-on effects to different sectors. So it's going to take a long time for that shock to be sort of absorbed by the economy. So what we've seen as a result of that is all of the slow-moving parts of the economy that take time to rebalance have been stretched quite quickly. So that includes the housing stock, which is inadequate to welcome the number of people that Canada's trying to push onto the stock. That's exacerbated the housing bubble. The health sector is becoming increasingly stretched by the fact that there are just suddenly a much larger ratio of people to doctors, people to equipment than was the case 3 years ago. General infrastructure, the same. Anyone in Toronto would see that the TTC is struggling compared to where it was in 2018. And so, you have this basic mismatch in terms of how fast immigration has happened and how fast the economy can adjust to that number of people coming. And you're more recently seeing announcements kind of recognizing this from the Liberal government saying, okay, we're going to put the brakes on this a little bit. We're going to slow down the number of non-residents in Canada. And we'll see after 2026 who's in power and where that all goes. But the basic fact is, I think I would describe this as a decade of immigration has been done in 3 years, and that is obviously disruptive in obvious ways. It also does show up in some of the macro numbers. It boosts GDP compared to where it would be without those people. But because there's a larger labor market, it also means your productivity numbers get hit. You have a larger numerator in your productivity calculation. It means any per capita measure is basically going down because of how fast the capita component is growing. So that's kind of where we are on immigration. We can talk through some of those different aspects.
And just so I understand this correctly, it's not so much the number of people that are coming into the country, it's the number of people that are coming in that are not contributing to the economy.
The one thing I should have mentioned is that the mix of immigration has changed as well. So it used to be skewed towards heavily high-skilled, permanent settlement-based immigration. There is now a much higher proportion, I want to say overall, but there's a higher proportion of immigrants that aren't sort of immediately going to work in high-skilled jobs. There's also an enormous number of students as well, who obviously students are paying their fees, but they're not sort of directly contributing to real output as well. So that's part of it. But I would say more than that, the issue is just the condensed nature and how fast it's happened. So even if everyone was super high skill, it's just difficult for the job market, for the infrastructure setup to absorb that many people that fast, especially when a huge share, over 50%, is going to one place, the GTA.
Okay, so let's talk about Toronto. It's a city of 5 million people. And the one thing that anybody will notice when they come to Toronto, whether it's on business or as a tourist, is the number of construction cranes that you will see in the skyline. And I just had a friend in from New York last week. He hasn't been here since 2019, he was shocked by the number of condos that have been built and also the number of cranes that you can see in the skyline. And I want to throw out a fun fact for you and our viewers, but there are currently 221 construction cranes in the city of Toronto as of Q1 of 2024. That compares to 104 in Q1 of 2019. And to put this into further perspective, the second highest city in North America with the number of cranes would be LA. It has 50 cranes, okay? So we have over 200, and it just gives you an idea of the type of construction that's been going on here. In the next 6 years, there are over 500 condo projects that are expected to be built. But I'm wondering what your comments about the Canadian economy and about the slowdown, also the lack of productivity, the decrease in real incomes. What is all of this going to do to the Canadian real estate market, more specifically the real estate market in Toronto?
It sounds like we should be in the construction leasing business. Should we? I don't know what we're doing, chatting about secure economics. Yeah, so some of the themes we've already touched on are very relevant, yes, especially the immigration question. But I think the way that we're looking at the Canadian housing market, Toronto especially, is that there are a number of very powerful forces sort of playing out at once. A lot of them are cutting in different directions. And so, some of the movements around sort of pricing, rents, all that kind of stuff have been quite confusing given, as you described, this enormous expansion in supply that's been happening and is continuing to happen. But how we see this playing out is sort of a period of ticking along as is. But this is no question, there's a bubble in the Toronto 1-bedroom, 1 and 2-bedroom condo market that is going to pop and cause a bit of pain coming through. So I'll play how we see that working. I think the first sort of puzzle we need to answer is, that number of cranes you mentioned for 2019 or over 100 is not small. It's not like we're suddenly seeing a boom. The sky has been changing around us now for 5-10 years, and there's already been a huge amount of stock coming onto the market. Why hasn't that led to a sort of collapse in condo prices? Because there hasn't been. They're down like 2% year on year currently, and way up on a 10-year basis. Well, the reason is that there's been demand. There's been demand initially because interest rates were very, very low, so it was an easy investment to finance, and so you have a lot of pickup, and all of those landlords do not find it difficult to fill the condo units because of the immigration surge we've just been describing, the number of students who need to be housed in Toronto, the number of professionals arriving, off the plane into a 1-bedroom condo while they sort of work out their initial lives in Toronto, and then eventually moved into the single family market. And so that's been sufficient actually not only to keep demand up, but actually rents are extremely high at the moment, and they've been growing very, very fast in Toronto. That's been strong enough to offset the increase in mortgage costs that most landlords have been seeing, and to keep demand for new units kind of ticking along. The other component I should mention, apart from the immigration component of that, is that housing affordability in the single family market, so multi-bedroom outside of the city and within the city, is as bad as it's ever been. So the combination of very high interest rates, very high prices has meant that people are just boxed out of that market. They're staying in the apartment, they're renting, and that's helped kind of keep everything flowing. But, as with anything that requires long-term capital investment, you get these super cycles, which are pretty badly misaligned with where demand and supply are at a given point in time. It's very analogous to the drilling and world development cycle in oil, where oil prices are high now, everyone digs, and then you get a glut. And I think that's exactly the kind of dynamics we're seeing in Toronto, where demand now is very, very high, and we're going to see massive oversupply in the future. Some of the things that are going to drive that are, firstly, just the sheer number of units coming online is going to start to see, they're going to start to struggle to put people in them. But the bigger problem is, we talk a lot about Canada's housing crisis. Canada's housing crisis is not about tiny downtown 1-bedroom flats. It's about general housing, and it's especially about the kind of desire for your own house, your own space. So most of the people sitting in these condos want to get out of them. And as mortgage rates come down over the next few years, as more is done to address the shortage of that type of housing, you're actually going to see an outflow of demand, especially with rents as high as that math starts to not work out in favor of people staying downtown. You're also seeing immigration growth tailing off a bit over the next few years, and so all those factors combined, we think point to a pretty poor outlook for the market. The one other thing I should point out is it's just that mortgage rates still need to reset for a lot of landlords, much as we spoke about in the residential markets. And so there's a question about how many of those landlords are going to be able to hold on rather than having to put these on the market. We could see, in addition to the new builds entering the market, a lot of existing stuff coming into the market too. And the final point, a lot of this is luxury. And there's only so big of a market for luxury units. A lot of the places that are struggling to sell now, sort of still under construction, but way below their sales targets. It's part of the reason.
Now, you mentioned that condo prices are only down 2% on the year, which is quite shocking because according to the Toronto Real Estate Board, as of June, there was over 6,200 condos for sale in the Greater Toronto area. Condo sales have plunged 57% year over year. Why have prices only declined 2%?
It's coming, is the short answer. So everything I just described kind of points to prices needing to reset to rebalance the market. As you say, there's not a lot of pickup, but I think we're still at a period in the general housing market in Canada where, people are happy to hold on for a higher price for now. But as that oversupply becomes more and more evident, you're going to have to see a reset in prices. So we think it's on the horizon.
All right, so let's move on now and discuss. So things don't sound too good in the Toronto condo market, but I want to move on now and discuss the commercial real estate market because this is also slowing. And vacancy rates in Toronto or the downtown core are 13.4%. That's up from 12% year over year. And though it's nothing like we're seeing in San Francisco where it's at 35%, but this whole work from home thing and this hybrid work schedule, it's really having a big impact on downtown core, on the downtown core, not just in Toronto, but every major city throughout North America and Europe. But what do you think is going to happen here?
Yeah, I mean, Toronto's not unique there at all. I think we're at an interesting point here now where we've sort of settled into what I think is probably the long-term work from home dynamic. I think, there aren't major changes coming in either direction. So this kind of hybrid schedule where you do need office space, but you need less office space or you can share a lot more because people are working on certain days, is probably where things will settle down. And so what that means is, yes, we do have excess capacity with downtown commercial market compared to what the projections were before we all realized we could do this. I think the consequences depend a lot on the types of buildings we're looking at. So it's less of an overall market pattern that I'd point out and more about what it means for differentiation between different types of buildings. So if you layer this work from home dynamic over the fact that a lot of companies still are seeing their downtown footprint as one of the easiest ways to reduce and report on their carbon footprint, what you get is that we think demand for the sort of grade A, high quality buildings stays extremely solid or even increases, right? So those buildings that have been recently retrofitted, recently built, recently renewed, that's all pretty solid. And it's as you move down market that you start getting into real trouble. And that's where we think, there's either potential to repurpose a lot of those developments. We think that's where the money will go kind of versus new build for a while. But that's kind of how we see it playing out. It's not a San Francisco where everyone's actually just left. The types of industries that you have here are different. It's not a sort of coding economy. It's, financial services, law firms, etc. They all still need to be in a certain amount. And so that kind of keeps things, it sets a floor into how kind of bad it can get. But I think it means you have to be very discerning in terms of how you think through commercial real estate investment at basically a flight to quality underway.
And you're right. It's just not a Toronto issue. This is happening right across North America. And according to Moody's, vacancy rates in the U.S. hit 20% in Q2, the highest that they have recorded since they started recording this number since 1979. So vacancy rates, the highest they've been since 1979 in the U.S. I can only imagine it's going to keep increasing, especially as these loans or lease agreements expire. But I want to get your thoughts now what this means to the Canadian banks, okay? Because they got big exposure to commercial real estate, big exposure to real estate, and I'm sure it would be interesting to know which one has the greatest exposure to the condo market in Toronto. But what's this going to do to the Canadian banks and especially loan loss provisions?
Yeah, and I have the pension funds in there as well because they're direct investors in a lot of the most of the downtown commercial real estate developments involve the pension funds either directly or indirectly. So I think there is an amount of risk to the financial system building up that we should be conscious of, and which regulators in Canada are talking a lot about. Banks in Canada are very well capitalized, very well regulated against these risks. This has been sort of tracked for a long time, and so I think it's not great from a shareholder outlook because I think there will be losses and write-downs, and we can see in the provisioning data already that both on the commercial side and the residential side, banks are kind of preparing for this, but they are well capitalized enough that we don't think there's a systemic issues at play. Where we would be worried about that is in the US and in the smaller regional banks, where we recently wrote a note basically saying, we saw the Silicon Valley collapses of last year. That was about very high interest rates, changing basically the duration, causing duration mismatches at the banks, which triggered solvency crises and then a run bank. That's been backstopped by the Fed, basically essentially layering deposit insurance over the depositors said, don't worry about it. These banks, some of them are still technically insolvent based on the treasury portfolio, but you're going to get your money out no matter what. And that's kind of kept everything stable. But if you layer over that, the fact that a lot of commercial investment is financed by the regional banks in the US, and a lot of those vacancies are in the kind of lower quality stuff, smaller towns in the periphery, peri-urban and urban areas, not downtown. That's where the really poor, really sort of underutilized commercial real estate stock is piling up, and there's a huge exposure there. So if you layer those two things together, the fact that regional banks are in a pretty weak position solvency-wise already, and then you start building in 10, 20, 30% write-downs on the commercial real estate portfolio, you start getting a genuine backing. And so that's, even as Canadian investors, I think the Canadian banks are kind of scaled enough and well provisioned enough to be able to absorb the shock and spread it out. In the US, for the smaller banks, that's just not the case.
So I want to summarize a few of the points you made. So first of all, we have a slowing economy in Canada.
Yep.
That's resulted in lower productivity. We have lower incomes, a lower GDP per capita. It sounds like the real estate market, or more specifically the condo market within the Greater Toronto Area, is in a free fall. And there's also trouble looming within the commercial real estate space. When we talk in 12 months from now, where do you see the Canadian economy going? Are we going to be in a deep recession?
I think we're heading into a period where that's a genuine risk, and I think very underappreciated risk. There's this kind of narrative, some of it's spilling over from the US, that there's just a soft landing underway. Not true. The labor market's cracking up. There's only a couple of services industries that are really keeping the jobs numbers going, but unemployment's all the way up to 6.2, and it's going to keep going. Price pressures are gone, so we don't need to worry about inflation. This is all about the real economy now. And there is real room for concern there. What happens when we speak in another 12 months is going to depend on where the Bank of Canada pins the interest rate between then and now. That's basically the ball game. If they are still restrictive, if they're still at, say, 3.5 to 4%, it means that the businesses and the households that are resetting to higher rates over that period are going to be a big drag on consumption and on investment for the Canadian economy. And that's going to have a big problem. They need to get at least to neutral, so between say 2 and 3% somewhere, just to take the pressure off the economy that the high rates are currently putting on it, and to start to offset a few of these effects. If there's a serious downturn in that time, they need to do much more. There's a risk that we get, 1 or 2 high inflation prints, as can happen on the way down. There's wobbles. We saw one 2 months ago, which was reversed last month. And that makes them hold off, or they see wage growth numbers that still look a little high. That's just wages in a few industries. Healthcare and education basically are still very hot. Wage growth in manufacturing and the goods economy is actually negative. And hours worked are sort of distorting things. There's a poor signal coming from the wage growth market, but if you're a hawk, you can point to that and say, oh, there's inflation coming from higher wages. So those are some of the risks. But, it's going to depend really on interest rates matching when the economy is telling them we need to be.
And the fact that the Bank of Canada has been cutting rates ahead of the Fed, can we surmise from that the Bank of Canada sees major troubles looming?
I think it tells you that the Bank of Canada is correctly reaching the view that the Canadian economy is weaker than the US economy right now. That's definitely true. It's there in the labor market, it's there in the GDP numbers. And so correctly, they are saying, we're a different economy, we're going to ease. The whole point of floating exchange rates is that we can do that, and we're going to make use of that mechanism. And so we are pretty bearish on the loonie, because I think the Bank of Canada has to cut earlier and deeper than the Fed. Even though we think the Fed has to cut too, and that keeps the loonie weak and maybe a little weaker. We have all sorts of recommendations about what that means and how you think about the TSX and which stocks benefit, which don't. But the point is, it's right that they're doing it, and they've signaled that they're nowhere near the limit of how much they can diverge from the Fed. And so I think that's at least something we can take comfort from.
My God, you're just full of great news, huh? So where do you see the Canadian currency going?
Well, at the moment, it's trading just above 70 cents to the dollar. We think fair value is actually around 70 cents. So, we don't think there's a whole lot more weakness to come, but there's basically no upside. We don't see a recovery. Like the Fed will cut, but the Bank of Canada will cut faster. There are a lot of industries which are sort of basically all the export industries. The tourism industry needs a weak loonie to kind of keep recovering and stay competitive. It's just a fact of a weak economy, a decade of poor productivity growth, etc. That should be reflected in your currency. And so, but we think that's pretty priced in, that divergence between the Fed and the Bank of Canada. We think both of those central banks will cut more than priced, but it applies on both sides of the coin. So somewhere around sort of high 60s to 75 is where we see the loonie kind of trade for the next year and 2 years.
Yeah, the FX kills me. I got to get a second mortgage on my home to take my family to the U.S. now.
Yeah, you'll have to go to Banff instead of Florida, unfortunately.
Well, Dylan, that was a great discussion, even though it was full of a lot of negative news. But if somebody wants to learn more about you and about Rosenberg Research, where can they go?
Well, first up is rosenbergresearch.com. That's where all of our information is. So you can learn about the firm. You can see everything we publish, which is, it's not just the Canadian economy. We write a lot about the U.S. economy. We write a lot about different asset classes, special reports, all sorts of trading tools. So there's a lot there. And you can see it all if you subscribe for a free 1-month trial for the full suite. Very easy to do. So that's one place to go. To hear more from me, I have a weekly podcast called the Rosenberg Roundup, looking at the U.S. and Canadian economy in the global context. It's short, 12 to 15 minutes a week, recapping developments and looking towards the week ahead. And we also chat about one special theme we're focused on each week. So that's on Apple, Spotify, YouTube. Very easy to find us, Rosenberg Roundup.
I'm a big fan of your podcast. I like it. It's short and sweet and to the point. So I would encourage all of our viewers to check it out. Well, Dylan, once again, great discussion. Thanks very much.
Always a pleasure. Thanks, Jim.